All right, what's up, everybody? Welcome to Trust Engine Mortgage Coach community. This will be the 11th month that Brian and Hale have brought some industry leadership. We're trying to bring things on a monthly basis, and we have executed, Brian. Thank you for doing this with me every month this year.
You're welcome. Thank you. I'm always glad to be here and always anxious to have these conversations with you. I look forward to them.
Yeah, I do too. And last year we did, or not last year, this year we did it twice live. We did it once at the NBA live, and that was last month. And then we did the Housing Wire Gathering together live. So
Right.
let's try to go 3 live events together next year.
I'll drive down to your house or you drive up to my house. We'll do one in the backyard, as it were.
Maybe we might have to do 4 then, you know?
Yeah,
So,
I'll bring a bottle of wine. It'll be even better then.
okay. So anyone listening to this, if you want to have Brian, if you want Brian and I to do this with some wine involved, let us know and we'll try to
Yeah,
make that happen.
exactly.
So, for most people, Brian Hale needs no introduction, but for anyone that's new in the business, Brian has been the head of production for Countrywide. Some of you youngsters don't know what Countrywide was, but it was the largest sales force and loan officer um, sales organization in the history of the mortgage industry. That's safe to say, right? Like, there's never
It
been a
was.
bigger sales force than
No,
Countrywide's.
no.
He ran production. He, before that,
You know
was a
what?
top.
Wells Fargo at its peak might have been slightly larger for a period of time, but suffice to
Just
say it was big.
is big. How big? How many salespeople did you guys have at peak?
At the peak, we were just over 11,000.
Think about that, guys. A mortgage company with 11,000 loan officers. There isn't even a mortgage company with that many loan officers now. So it just gives you some perspective of what it was like back in the day. He was also a top producing mortgage professional that before anybody was doing 200 million, he did it. So he knows the street, he knows the C-suite, and we're going to talk about leadership in November of 2024. We are 1 month away from 2025, which I'm personally pretty pumped about. So Brian, why don't you where do you want to start in November? It is November 18th on a Monday. What do you think the C-suite needs to know about? What do managers need to know about? What would be useful for loan officers to know about right now?
Well, at the risk of sounding redundant to some of the other conversations that you and I have had through the course of this year, um, I was just mentioning to you that I was interviewed on Housing Wire's podcast by Sarah Wheeler, the editor over there, last week that I think I published out in Housing Wire, and I had it up or have it up on my LinkedIn and my social media feeds. But one of the things that Sarah wanted to talk about was how I felt about housing in general post the election. And on that podcast, and certainly not on this podcast, am I going to talk about politics necessarily, or win or lose, or who I was hoping for, any of those kinds of things, but really just the outcomes, which I think are the only thing that's material, right, in the process. And so, one of the things I told Sarah is that, look, I think we don't yet know what the true outcomes will be, right? We see the market has reacted, I don't think just to the election in terms of interest rates, it's reacted to the Fed, it's reacted to data, it's reacted to a whole bunch of things. But what I get all the time, and I know you get it as well, is what do I think is going to happen with interest rates? And then what's this output of the election? And two things. One, I think we'll likely see a more accommodative regulatory environment. Although I don't, last time when Trump was in, they had a much more relaxed approach to enforcement around certain topics. But oh, by the way, the states came rushing in and filled that gap in a lot of different ways. And then secondly, one of the things I said on that podcast was, one of the things I counsel my clients on is don't forget that many of the federal laws and state laws that we all have to live with every day have these really long look back periods as part of the law, meaning that, okay, so yeah, maybe for 4 years things were easier than they were in the Obama administration or in the most recent administration with President Biden. But I don't think you should take a lot of comfort in it, because the next election, unless you believe that the Republicans will rule the world for the rest of our natural lives, which, there tends to be kind of back and forth in our politics. We're a 50-50 country, no matter how you look at it. And so if you believe in the next election somebody else might win, the ability for regulators to look back and to hold you accountable for what you did, even if the CFPB or state regulators or other regulators are not as strident in their enforcement or essentially regulating by enforcement policies. The next group up absolutely can, and then you're going to be held accountable. So I just start from the premise that whether you think things are going to be easier or not, doing remarkably dumb things to consumers, I don't think is a great business strategy in terms of building a long-term franchise that's insulated from those kinds of things. And so you can't really control regulation. You can vote, but you can't control how the regulators are going to act. You can't control interest rates. So then the question becomes, what can you focus on? And I know you and I share this view, to focus on the controllables, to focus on the things you can do, right, in that process. So I think I start with rates are up since the Fed made their first cut, right? We've lost about 60, 70 basis points in rate. What are the things you should be back focused on? And I think you got to go back and focus on the things you can control. And that's about how you're directing your sales force, who you're recruiting, your economics, your cost, your revenue strategies. I know, thanks, Dave. You just participated in the weekly roadmap this past Friday with Jeremy Forcier, which I know is a great acolyte of yours and somebody who deploys a lot of your tools. I appreciated you two guys coming on for 35 or 40 minutes and giving really specific tactics, as an example, on how to do a better job at converting the leads you already have. You want to make more money in this business? Have a better conversion of the leads you're already seeing, and then also go out and prospect for new. That's something you can control. That's the advice I give my clients, and it would be the advice I'd give anybody who's listening to this, is
I
how do you
love,
I can focus on those. So
love that. What do you think of this? I did in my Monday leadership message every Monday. I try to do a hey branch managers message, and I've executed on that pretty well for about 2, 3 months. And today I said, let's obsess this entire week on the art and science of lead conversion.
yeah.
And I really, and by the way, thank you for inviting Jeremy and I to be part of your weekly roadmap. If you guys are not following weeklyroadmap.com, check it out. Oh, actually, is that the domain? Is it
Yes,
weekly road? Okay. So they
it's
can,
well, the domain is actually WKLY roadmap. It's all one word, WKLYMAP. I'm sorry, WLKYROADMAP.com
okay, we'll
is
put
the
a
actual
link down
domain.
below.
We'll
We
put
will
the
put a
link down
link down
below.
below.
Excellent.
Check
So,
that out. And by the way, Brian, we might need to just have like Brian Hale's weekly roadmap and get that
by the way,
domain.
we can just send you a QR code that
Okay.
somebody can
Okay.
just
Well, we
flash
we
on.
we
Boom, we're done.
have that coming linked down below. But Brian asked me to come and talk about lead conversion. And Jeremy and I did some prep on that. I have been talking about LO comp for a few weeks now on social media. So we might get
I listened to your message this morning.
oh good. So
Yeah,
maybe
yeah.
we'll talk a little bit about that. But what do you if someone this week, we're gonna get this posted pretty quick. It is the 18th. I'll try to get this posted by tomorrow. But if and I want you to speak to C-suite, I want you to speak to middle management, and then speak to branch managers all up and down that food chain. If this was your sales force, and this week, guys, we're going to crush it with lead conversion, where would you start? Like, what would be your message to your full sales force?
I would make everybody listen to Jeremy's message from Friday, right? I mean, literally, because I think people have a tendency to make things more complicated than they need to be. And they think there's such, this like nuclear scientist, mad scientist strategy that only a few people can execute on. I think only a few people do execute exceptionally well on lead conversion. But I also believe that the vast majority of originators could improve their lead conversion execution by just literally, on Saturday I did a video that got published this morning on my LinkedIn and other social media feeds talking about Friday's meeting, right, with you and Jeremy.
Nice.
Just basically saying, guys, I don't get it. We brought you the bike. All you have to do is jump on the bike and pedal the bike, right? If you listen to Jeremy's message and your message from Friday, which I'd encourage you to, if you want to repost it as part of this or put a link to it, just go listen to what he does. Not unlike Joe Massey 2 weeks ago that came in and talked about how to build a team and to help follow up. And he had very specific scripts at helping people unlock their equity and going back to his existing customers. These are not, you don't have to be a rocket scientist to execute on these strategies. You have to listen, memorize, and go do and practice and practice and practice and practice. And what I took from Jeremy's call, and he's talking about some of the ways that he talks to his clients and how he thinks about lead conversion. First of all, he knew his conversion. He knew his conversion percentage was down this year over previous years. But what he had made up for, although his lead volume was down, his conversion was up. And he knew both of those numbers. And I can remember he was looking on the screen going, yeah, year to date, I'm X% down in leads, but I'm up Y%. What does that tell you? It tells you that he actually knows his lead volume, up, down, or sideways, and then his conversion percentage. And then he immediately knew, oh, by the way, I average 11 basis points of price exception, but many of the salespeople I work with are much higher than that. Step one, you want to improve a process at work, whether you're an originator, a branch manager, or C-suite, you have to measure. You got to know what the math is from to. I'm down 28%, but I'm up 11%. And oh, by the way, I have 11 basis points of PE. I would bet you today, Dave, and I know you wouldn't take this bet, it's not 10% of salespeople in our business that can quote you those three numbers off the top of their head.
I definitely would not take that bet.
Yeah, it's not 10%. It's probably
Yeah.
some materially smaller number.
Yeah, it's less than 5%.
But if
Yeah,
you're sitting listening to this message today and you don't know those percentages, you're not sufficiently focused on lead conversion. Because if you don't know those numbers, you can tell me all day long, no, I'm really good at it. Really? What's your percentage? And if you don't know that, you don't know. You don't know if you're good, bad, or indifferent against the best in the industry, right, in that process. And so I think if you're C-suite, are you helping your sales force, giving them the tools to know those percentages, know where they are? If you're a branch manager, do you know what yours are? Do you lead by example? Do you then talk to your sales force about how they compare of their peer group within your branch as compared to you or the company? And it's not about being critical. Hey, Dave, your percentages are lower than the next guy. That's not very motivational. But hey, Dave, your percentage is X. Let's you and I start talking about how we improve those percentages. That if everybody in your branch got one more conversion this month, what would that mean to you personally, to them in terms of the economics? And the economics are easy to figure out. You know what the average commission is if you're an originator on your book. If you got one more loan every month times 12, would that mean you're making more money or less money? You're making more money.
So here's the takeaway. If you are in leadership, make sure that you are being effective at helping your loan officers understand where they're at and giving them context so that they know how they compare to people that are winning most.
Well,
And
when
like
I
who are the
talk to
20?
go ahead, Dave. I'm sorry.
No, you go ahead.
What I was going to say, when I talk to C-suite folks as a consultant, I constantly hear bitching about the fact that they invest in CRMs and marketing, the marketing department, and oh my God, they cost a lot of money and it's expensive, and maybe I should cut the budgets and I should do these kinds of things. If you're out there investing and then you're not coaching on the tools and the specific tactics on improving conversion, I'd like to think that every originator would say, teach me, teach me, teach me. Let me go find somebody who's doing it well and model what they do. Most don't. And if you're not helping them with those tools, you probably are wasting your money. But if you've already invested and you don't think about, am I measuring? Am I helping people understand where they are? Am I giving them the tools and coaching and training and those kinds of things, using some of the tools, Dave, that you have, that Jeremy talked about using every day? Then I don't get it. I don't, you're focused on the wrong things would be my only point, right?
Yeah. Well,
Every
and it just
originator If every originator in your company closed one more deal last month, what would the impact be to your economics? It's material.
Yeah, no, it's major material, especially when, since we talked last, we got another quarter of profits. I think it was like 17 basis points,
18, up from
18 basis
17 up to
points.
18 in Q3.
Yeah, and when you look at what would an extra loan do from your sales force, what would a reduction in basis points of, let's say you could reduce price concessions by 9 basis points, which you could if you improve conversion. Let's say you could increase conversion by 10%, which you could with effective measuring and sharing. Like there's just like when I was doing the math and talking to some C-suite executives, like literally just by improving conversion, we could add another 10 basis points or more, could be 20 basis points in profits if we could materially impact credit report to
Dave,
funded loan.
let me just make the obvious statement. If the average IMB in the MBA survey is making 18 basis points, and you improved by just 6 basis points, you've improved your bottom line by a third. By a third, right? If you did it by 20 basis points, using your example, you've doubled your profit, right? And so this is a business of nickels, dimes, and basis points. And if you can pick those pieces up along the way, think about it. If you just improve your conversion, it's not, you haven't spent any more money to go get the leads. You're just improving the leads that are already coming in. But if you don't know what your lead conversion is by originator, how do you know? How do you know where to put your efforts? It starts there, right? I think it has to start there. Whether you're
Yeah.
an originator, self-assessment, a branch manager, your team, the C-suite, your company, head of production, those are the things I think you need to be focused on.
So there's one takeaway. Let's focus on conversion. Obviously, if you're watching our channel, I'm going to obsess over that this entire week. I'm interviewing four top loan officers, Jeremy Forcier level people tomorrow, and 9 o'clock Pacific. By the time you're watching this, it'll probably already have been done. So we'll put the link down below. I'm also going to get a link to Brian Hale's weekly roadmap with Jeremy and I. So if you want to watch some content that will help you improve conversion, they'll be in the if you watch this on YouTube, they'll be in the show notes. So Brian, I do want to before we're done, at some point I want to talk about LO comp, but what are some other topics you want to make sure we talk about throughout this conversation?
Um, where I think there's also a real opportunity both for an originator, a branch manager, and a C-suite. The whole industry, I think, struggles with this whole concept of loan officer assistance because of the cost, the impact, who's paying, is the originator paying, is the company paying, is they sharing, how's that all work? We had Joe Massey, who I know you just interviewed on 2 weeks ago, talking about specifically how he has his team organized. This is a guy who's, again, a 50 to 100 million a year purchase originator, Denver, Colorado, Castle and Cook, um, who took a month and went on vacation to Europe for a month. And while he was gone, his volume went up in terms of new business, new lead conversion, and his fundings went up for the month over the previous month before he left on vacation. And with just a couple of check-ins a day, he was able to run his business from Europe while running the marathon in Burgundy and having to stop every mile to have a glass of wine. That sounds like a pretty good life, to be honest. But again, he explains how to ride the bike. You just have to get on the bike and pedal the pedals and follow his system. And one of the things he does is he has he has a small team, by the way, but everybody only has 3 roles. Makes it very simple. You don't have to be a rocket science to work on his team, although there are a lot of bright, very smart, hardworking people on his team. That's a credit to Joe and to the team. But how do you get more out of the horses you already have? And I can assure you, if you're an originator or branch manager, somebody up in the C-suite is up there thinking, how do I reduce the number of PAs, LOAs, whatever you want to call them, because it's a cost. And it is a cost if they're not productive, if they're not helping you do more loans. The question becomes, how do you take your existing team, assess it, make sure you got the right people, make sure they're organized right, use this three job rule, three things that they're each responsible for, hold them accountable, and drive more volume. It's good for them. They make more money. It's good for you. You make more money. The company makes more money. Those are the key things. And I think, Dave, what all this comes down to, whether it's lead conversion or managing your team well, self-assessment,
I like
right?
that.
It's painful, man. It's painful. What do you do well? What do you not do well? Can you delegate the things you don't do well? Hang on to the things you do well. Rinse and repeat.
That's
Self.
interesting. I like that. I love the thought of self-assessment, knowing that we're in November. It is business planning for 2025. And this is actually kind of a good segue to LO Comp because I put a little process together. I think I did it last week on LinkedIn on the Monday update. I said, if you want to know if you have the right comp, like you're a loan officer and you're like, hey, am I charging the right amount of basis points? I would start with, are you achieving your financial goals? Are you closing the loans you want? And if the answer is yes, there's a really good chance that you're priced appropriately. But I still like if I was doing this, there was 100 people in a room, I'd say, okay, the 5 to 10 people that raise their hand that they're hitting their numbers, because it wouldn't be more than 10%.
Right.
And actually, those 10% probably wouldn't be satisfied. They were like, well, I could do
I
better.
can do better. I can do better.
Yeah, but
Yeah.
a few people might raise their hands. And then I
Look,
was
I
to
took that.
say,
I took that from our conversation with Jeremy on Friday. He thinks he can improve,
yeah, right.
and
They
he's
will,
killing it.
but they are doing really well. And then if you ask them, what is your conversion and are you in the top 20% with your peers? By the way, if your conversion is among the top 20% compared to people with the same type of lead model, their peers of yours, there's a good chance that you're pricing loans appropriately. What are your thoughts on those two questions being good self-assessment questions?
Yeah, I agreed. I would only maybe make one comment on the pricing part. If you're in the top 20% because you're giving the revenue away and your attitude is screw the company, as long as I make money, I'm good. It's not a sustainable model long term because your company will go out of business. You may not feel it, you may not see it, you may not anticipate it, but if the best price in town, no revenue model is not a sustainable model. So people need people are in this business to make a buck. And you talked about 18 basis points, Dave, 17, 18 basis points. That's just a little bit north of an eighth.
Yeah, right.
So if revenue comes down an eighth, you're back to underwater.
Well, and by the way, isn't that sometimes like an eighth can be 25 basis points? I mean, like
No, well,
it's
look, an eighth is 12 and a half, right? Just
okay,
mathematically.
so it is 12 and a half.
Yeah, it's
Got
12
it.
and a half. So if you're 18, you're a little north of an eighth. You're right between an eighth and a quarter. Point being is what I see in my clients right now, we're seeing an increase in price exceptions because
No, but
rates are,
I'm saying the cost of that eighth in points
yeah,
is an eighth is not necessarily a cost. I mean,
yeah.
just
It
like,
may or may not be. My only
yeah,
point
right.
is if your economics back up by an eighth or a quarter, you've just wiped out 18 basis points of profit. You're back underwater as an industry.
Yeah,
And being underwater, losing money on every loan or most loans is not a sustainable model. And I've always had a simple view that an originator's best friend is to work for a profitable company that can invest in technology and training and CRMs and other kinds of things. If your company's losing money and you're making money, it's not a great long-term model, is my only point.
yeah. And here's another thing, because when you start doing the audit, and I'm going to talk about this in this art and science, art and science of lead conversion. But if you think of your product as here's my rate, here's my payment, and it's a program, a 30-year fixed rate, like that's not your product. Your product is your customer experience. And if you give like a obviously mortgage coach, if you're giving more than a rate sheet to people, but you're showing how you solve problems, you're giving them a better experience, you can charge more. So I make a case that especially if you're an IMB and all you do is do mortgages and do it great, you need to upgrade your bar experience.
Well, I think one of the things Jeremy talked about on Friday, and I don't mean to keep harping on Jeremy, and I've seen others like him that do this very well. He never gives a rate quote. He doesn't start by taking an application. He starts by saying, what are you trying to accomplish? What are your pain points? What are the things that you struggled with in this process of trying to find a home or buy your first home or buy your second home or whatever the case may be, so that he fully understands the customer's needs and desires, what's important to them. Is it payment? Is it down payment? Is it why are they buying this house? What's going on in their life? And in most cases, as he develops that, he then understands the product need, the approach, and price just bluntly becomes a secondary conversation. That's what was clear to me. And to the degree you lead with a price quote and sending the customer a link to your electronic 1003, I think you're dead, because others like Rocket and others are better at it than you are. And you may or may not ever get a second chance with that lead, versus spending the time, investing your time. One of the things Jeremy said is he talks to every customer that comes through, whether his team's involved. He's doing that first interview,
Yeah.
that what's important, build the relationship, convey trust, understand the customer's true needs and aspirations in life. Everything gets easier after that. Everything gets
Yeah.
easier.
Yeah. So according to Brian Hale, first of all, measure everything effectively in a useful way. And then it all starts with finding the borrower's needs, goals, and dreams. And if you start off with those two
I'd
things,
add a third item, self-assess, right? It's
self-assess.
been said you can lie to others, although that's not a very good strategy as well. You lie to yourself, disaster waits to happen, right? You gotta be honest with yourself. What are you good at?
So what's a question or two that I should ask Mitch tomorrow? We're going to be on stage. It'll be in our YouTube channel. It's going to get watched by a lot of leaders. What do you think they want to know?
Look, I think for part of your audience, I would ask Mitch, look, I think I already know the answer, but Mitch, the fact that the election's over and there's a lot of commentary about, a less strident regulatory regime going forward, what advice would you give C-suites around the prudence of doing things that is maybe edgy or right at the edge of where the law starts and stops, specifically around regulators' look back capability 5, 6 years from now? That's question one. Secondly, how smart of a strategy do you think it is to risk your reputation around being labeled a predatory lender,
Right.
right? Because this whole issue of how we price, how we market, redlining, disparate pricing, those kinds of things, the laws aren't going away unless regulatory legislative change happens. That's harder to do than it sounds, even if you control all the houses of government. What advice, you're sitting in a boardroom with the C-suite team and the board of directors, what advice would you give them about how they should run their company around these key fair lending laws, regulatory compliance, those kinds of things? Do you think it's prudent to knowingly go out and take immense risk, or how should you think about it? That's what
Yeah,
I
I
would
like
ask.
that. I had some things similar to what you said, but I just updated my questions. Thank you, Brian Hale. Appreciate that. So before we run out of time here, is there any other just Brian Hale, you're talking to everyone in this community, everyone that follows me. Else you want to make sure they hear or that you're coaching your clients on right now?
Look, specific to the mortgage business, I saw this article just a day or two ago. In fact, I mentioned it in the Housing Wire podcast about now with the change in administrations, again, without regard to how you feel about it, what's the likelihood that Fannie and Freddie come out of conservatorship and go back privately owned? I had this debate with the great Dave Stevens for a lot of years. I think he finally came around. I think we saw it in a common way over the last couple of years. which is that Fannie and Freddie, Ginnie as well, FHA, VA, USDA, pick all the letters, are essentially public utilities. And I think you're going to hear a lot of commentary about, well, the Republicans are in charge and the Republicans generally think that the government shouldn't be in housing. Let me help you with a little bit of that. And I'm sure I'll get some hate mail as I do other places that I say this. 30-year fixed mortgage rates don't exist anywhere in the world except in the US, right? They just don't exist. There's a reason for that. And part of the reason is that the Fannies and Freddies of the world, which of all the things they've done, good and bad, they created standardization, standard documents, standard credit boxes, standard approach to evaluation, such that you could homogenize the business, securitize it, and bring in capital from all over the world to feed the US housing industry by buying mortgage-backed securities. You start screwing around with that and changing such that the reason non-QM securities trade at a higher rate and a higher yield is because they're not homogenized. They have all kinds of little different quirks to all these programs. With Fannie and Freddie, they're great, and FHA, one of the great contributions to the US housing market and to our civilization has been standardization. You start changing that model and you try to disaggregate this and send it all back to a bunch of private companies all doing different things. If the US government was not involved in housing today at some level, rates today would be 200 to 300 basis points higher. That's the
Wow.
short answer. And so what always happens is, I don't think anything will happen. That's my bet. And it doesn't happen for one single reason. A lot of people raise money on this issue politically. Well, we should vote to take them out of conservatorship and send them back. First of all, Fannie and Freddie contribute almost $1 trillion a year to reducing the deficit because all their profits go into the general fund. So if you take them out of government, you lose that, and you got to replace that either by raising taxes elsewhere or doing something else. Second issue is smart analysts will come to these congressmen and senators because it happened last time and go, let me show you what happens in your district if you take this away and you break it. Remember, real estate is about 70% of our GDP, one way or another, right? By cars and washing machines and different things, how people educate their children by using equity, right? There's a whole bunch of impact here. And they explained to the congressman, you vote for this, you're not going to get your mother's vote next time around. And the one thing I can share with you, and I'll say this as directly as I can, I'm sure out of 535 congressmen and senators on Capitol Hill, there's maybe a few Mother Teresa's or Gandhis that are in it for the greatest value, but their number one priority is reelection.
Right.
That's it. Everything else pales to reelection. And so people will beat their, yes, we should do this. And then somebody shows them this analysis and they go, you know what? I think we should study it for another 2 years, right? Because they're unwilling to step off that cliff and take the consequences. And so I think nothing happens. I hope nothing happens. We have a really well-oiled system that actually, I don't, to be blunt, I'm not smart enough to know why we have two of them anymore, but I don't think anything happens because the potential downside impact is immense. And I don't care what your politics are or how you see it. If you're in this business, you want these public utilities to help make the machine run. Without them, we got real problems.
Yeah,
And
no,
you kill the golden goose that is real estate in America, you're not going to get your mother's vote. Your mother might, in fact, vote to impeach you. So,
uh, I love how direct you are. So on the airplane home last night, I was up in Portland for the weekend, but I read the Housing Wire put out an annual report, and I first of all, I was really impressed. I mean,
yeah.
it
I've printed
was
it. I haven't read it yet, but I'm going to do the exact same thing this week.
yeah, I scanned it yesterday. I'm going to read it again this weekend. But let me see what my notes said. They were saying that they thought interest rates kind of like netting it out. And I loved it because they not only gave their opinions, they listed out, Sachs, NAR, MBA, everybody. And then they netted it out at a range of 5.75 to 7.25 during the year. Any thoughts? That, by the way, we're
No,
talking
I think,
2025.
I think there's a 30 or 40% chance that the high end of that rate range is higher. I
Okay, so
think,
you think 7.5-ish or higher.
or higher. Look, I think there's a couple things that could happen that we could start touching eight again. I don't think it'll happen, but I think there's a chance that it'll happen. Let's put it that way. I think that the chance and likelihood of higher rates between now and at least next spring is much higher than it was just a few months ago.
Yeah, well,
Second,
remember, they're calling it for the entire year.
yeah,
So,
yeah, yeah, yeah. But I think rates could end up being higher for the entire year than that forecast would suggest. I also believe there's a couple scenarios where rates could come down further, which has to do with a recession. If you
right.
break it and the economy goes into a recession, a material recession, you could see lower rates. That's the good news. The bad news is a lot of people lost their job and can't buy a house. And so
Right.
house values come down, appreciation slows down. It's probably good for inflation, by the way, but you have a smaller home buying pool that can afford a house, and you have delinquency and other things that go with that. So I just think it's much more volatile than that would suggest. I think that's the good middle of the range. You know, the idea is somehow that we're going to see threes and fours again. I'd give up on that.
Yeah, I don't know. I don't forecast it, but it's a great report. A
I
lot of
don't
tremendous
forecast it
data,
either.
very well written. I would urge you guys to download it. I will put a link. It's called the Housing Wire Forecast, Market Forecast for 2025. So link down below. It's a must read for loan officers. And then my closing thought, and I'll give you yours, is with all that aside, do read this information because I think you need to be smart in order to have personal confidence when serving a family. And you need to have great conversations with people so that they feel that they're working with a professional that knows what's going on. And then who cares? Control what you can control. All you can control is when you are talking to a consumer, being present with that consumer, asking them questions about what are their hopes, their dreams, their goals, and then take the time to deliver a consistent experience to that consumer. I'm going to call it a sales experience, but really it's just a like get them super excited about buying a home based off their goals and their dreams. Like if their
Yeah.
goals and their dreams and their beliefs of the market aren't going to get them excited, well then the best thing is to meet them where they're at and help them make an informed choice that's right for them. So control what you control. Closing thoughts, Brian.
Yeah. So to tee off two comments you made. First of all, it's not your next deal you're on the phone with. It's a family in search of a home
Right.
to raise their kids, to achieve their goals. Nobody wants a mortgage. People want a home, right? It's just a means to an end. If you remember that, it changes your tone. And if you come across transactionally, people will pick up on that. Secondly, whatever you believe, whether you take my comments or what's in the Housing Wire forecast, 5.75 to 7.25, whatever the case may be, I'm back to self-assessment. Ask yourself when you read this, if it went to 7.25 or higher, what things would I have to change in my business to make the money I want to make, to do the volume I want to do, and to serve my clients and my customers, my referral sources and my customers? What would I do in that environment? If rates go down to 5.75, what would I change about what I'm doing every day in that environment? Have the game plan, right? You watch pro teams, and I'm a big NFL and college football fan. They come in oftentimes with the first 25 plays of the game scripted out. And then they make adjustments. Typically, the winners in the NFL are the teams, the coaches who can make the adjustments the fastest at halftime,
Yeah.
right?
True.
And so, but it all comes because they've got a playbook. We talked to Jeremy. He has literally a book he wrote, a
Yeah, it's
book.
called the
Yeah,
playbook. I
called
gotta
the
get me one
playbook,
of
right?
those.
And so this concept of self-assessment, what would I do if, how should I change it now? What would I do differently? Think about it now. Think about it on an ongoing basis so that when the inevitable happens, you're not caught flat-footed. And I think that separates you from the vast majority of your peers if you do those things.
Yeah. And after you say what you said, I just want to add on one little piece that not only are you there to serve that family for their mortgage needs for 30 to 50 years for life, but if you really want to differentiate yourself, be the mortgage professional that's doing financial freedom lending. People want to own a home and they want to achieve financial freedom. So be the one that is like showing them ideas and strategies to own that home, either pay it off faster if they follow Dave Ramsey, or get one loan versus another, invest the difference, regardless of however they invest money, be the financial freedom lender that's helping them achieve homeownership and financial freedom, and you'll completely differentiate yourself. And for all you
Plus,
managers,
create trust. You create trust.
yeah, you
Right?
create trust, differentiation, you create more value. And for all the executives on this, whoever executes that best is going to have a seat at the table, regardless of Zillow Mortgage. We could have talked about how fast they're growing. And by the way, they are growing fast. They are becoming a legitimate player. And when you look at the eyeballs that they control, the data-driven, process-driven operators that they are, they're gonna figure it out. Like, are they gonna dominate the world and kill everybody else? Probably not. But are they
Maybe.
going to continue to grow? Yeah, maybe. But by the way, we should have talked about that. We'll talk about that next time. I'm sure we'll have a lot to talk about in December. If you're getting value from this, give us a like, share it with other leaders that you think would get value from Brian and I. If you are not familiar with the weekly roadmap by Brian Hale, every week, every Friday, he's putting on an incredible sales meeting. So if you're a leader and you want to upgrade your sales meeting, it's something to follow yourself. And if you
Right.
don't have a leader that's putting on a great weekly sales meeting, Brian is. So make sure you check that out. Hope you got value. Brian, super grateful for doing this every single month. And I look forward to our December leadership session.
As do I, Dave. Thank you very much. It's always a
Take
pleasure.
care,
Thank you,
brother.
man. Take care.
All right. This is a wrap.